There is a black box worth $1.7 trillion sitting inside the global financial system right now. And the money feeding it may include your retirement savings. It has no public price, no daily valuation, no regulator with a clear view inside it. Wall Street calls it private credit. They call it safe. They call it the future of lending. But a growing number of analysts, some of them the same people who warned about mortgage-backed securities before 2008, are calling it something else entirely. They are calling it the next Lehman. This is the story of how that black box was built, who built it, and what happens when it breaks. To understand what private credit is, you first need to understand what it replaced. Before 2008, if a mid-sized company needed a large loan, say $400 million, it went to a bank. The bank underwrote it. The bank held it or sold pieces of it into the syndicated loan market. Either way, there was a public record, a regulated institution, a price you could find. Then 2008 happened. Banks nearly collapsed under the weight of loans they had packaged, hidden, and leveraged beyond recognition. And the regulatory response, the Dodd-Frank Act, made banks far more cautious about lending to riskier, mid-market companies. That caution created a vacuum, and into that vacuum stepped some of the most powerful asset managers on the planet. Firms like Apollo Global Management, Ares Management, Blackstone Credit, Blue Owl Capital. They built an entirely new lending ecosystem, one that operated outside traditional banking regulation. They raised capital from pension funds, sovereign wealth funds, endowments, and increasingly everyday investors through products like business development companies, or BDCs. They used that capital to make direct loans to companies that banks no longer wanted to touch. Leveraged buyouts, distressed businesses, companies with high debt loads and uncertain cash flows, and they charge handsomely for it. Yields of 10, 12, sometimes 15%, in an era when government bonds paid almost nothing. The concern is this: private credit has grown from roughly $500 billion in 2012 to over $1.7 trillion today. It has tripled in just over a decade, and almost none of that growth has come with meaningful regulatory oversight. The loans are not publicly traded. They have no daily market price. The companies borrowing the money are not required to file public disclosures in the same way public companies are. The people holding the risk, pension funds in Ohio, university endowments in the Midwest, retail investors in BDCs, often have no clear picture of what that risk actually looks like until it is far too late to act on it. Imagine a company, call it Meridian Industrial. It is a mid-market manufacturer. Revenue of roughly $300 million per year. It carries substantial debt from a private equity buyout 5 years ago. It needs to refinance. A traditional bank looks at Meridian's debt load and passes. So, Meridian's private equity sponsor picks up the phone and calls a private credit fund, one of the major platforms. And within weeks, a term loan is structured, $600 million, floating rate, tied to SOFR plus 6%, secured against Meridian's assets. Here's where it gets interesting. That loan does not sit neatly on one firm's balance sheet. The originating fund syndicates portions of it, sells slices to other private credit funds, to collateralized loan obligation vehicles, or CLOs, and to BDCs that are partly owned by retail investors. Each of those receiving entities has its own leverage. Many BDCs borrow against their loan portfolios to amplify returns. CLOs are structurally leveraged instruments by design. Suddenly, that single $600 million loan to Meridian Industrial is sitting, in pieces, across a dozen different leverage vehicles. And here is the part that matters most. None of those vehicles marks that loan to market on a daily basis. The valuation of Meridian's loan, whether it is worth 90 cents on the dollar, or 60 cents on the dollar, or 40, is determined not by a public market but by internal models. Models run by the very firms that originated the loan and collect management fees on it. This is not speculation. The IMF flagged it explicitly in its April 2024 Global Financial Stability Report. The Federal Reserve's own supervisory guidance from late 2023 raised concerns about valuation opacity in private credit. Even the SEC launched targeted examinations of BDC pricing practices in 2023 and 2024. When a public bond defaults, the market reprices it instantly. Contagion is fast but visible. When a private credit loan defaults, the fund has discretion over how and when to recognize that loss. They can extend the loan, they can restructure it quietly. They can roll the problem forward, sometimes for years, while the valuation on paper barely moves. In the industry, they call this extend and pretend. Critics call it the same mechanism that allowed subprime mortgage losses to stay invisible, until the entire structure collapsed at once. The IMF estimates that roughly 35 to 40% of private credit borrowers in the current portfolio universe have interest coverage ratios below 1.5, meaning their earnings barely cover their interest payments. In an environment where rates stay elevated, that number deteriorates fast, and all of that sits, quietly, invisibly, on the balance sheets of pension funds in Ohio, university endowments in the Midwest, and retirement accounts belonging to people who have never heard the words private credit in their lives. If you're still watching at this point, you already understand why this story matters in a way that most financial media hasn't bothered to explain. The question we haven't answered yet is the most important one. What does the actual unraveling look like? Is this a slow bleed, or is it a cliff? Drop a comment below with what you think the trigger will be. Rising defaults, a rate shock, a major BDC cutting its dividend. Keep watching, because the next part is where the mechanics of a potential collapse become impossible to ignore. The comparison to 2008 is not casual. The structural parallels are specific and they are documented. In 2007, the subprime mortgage machine had three defining features. Opacity. Nobody could see the true quality of the underlying loans. Leverage. Every layer of the structure was borrowing against every other layer. And interconnection. The same risk was distributed across hundreds of seemingly unrelated institutions. Private credit today has all three. The opacity is structural by design. The leverage exists at the fund level, the CLO level, and the BDC level simultaneously. And the interconnection, the fact that the same loan to Meridian Industrial sits in pieces across a dozen different vehicles held by pension funds, endowments, and retail investors, means that when the loss finally surfaces, it surfaces everywhere at once. Here is what a plausible stress scenario looks like. Rates stay elevated through 2025 and into 2026. The weakest private credit borrowers, those with coverage ratios below 1, begin missing payments. Funds extend and restructure quietly for as long as possible. But the losses accumulate, and at some point, triggered by a large, visible default that cannot be quietly restructured, institutional investors begin asking for redemptions. BDC investors who can sell their shares sell them. The BDC must liquidate loans to meet redemptions, but there is no deep liquid market for those loans. The bid disappears. The fire sale creates price discovery, real price discovery, for the first time. And what that price discovery reveals is that the internal valuations were too high, dramatically too high. Other funds holding similar loans are forced to write down their own portfolios. Pension funds report losses they were not expecting. Retail investors and DCs see share prices collapse. The companies borrowing through private credit, already leveraged, already barely covering interest, find that the refinancing market has closed overnight. This is not a prediction. It is a sequence of mechanical events that follows directly from the current structure. The IMF's own stress tests suggest that in a severe credit deterioration scenario, private credit losses could create spillover effects into public markets, precisely because the leverage and interconnection make containment impossible once confidence breaks. The regulators know this is a problem. The Federal Reserve knows. The SEC knows. The IMF has said it plainly in writing. The question is whether knowing is enough, or whether, like 2008, the institutions with the power to act will wait until after the fact to explain why they couldn't have seen it coming. Private credit's defenders make a legitimate point. Unlike 2008, these are not federally insured deposits. The If a private credit fund loses money, the government is not obligated to bail it out. The losses, in theory, fall on sophisticated institutional investors who chose the risk. But that defense assumes the losses stay contained. It assumes the interconnection doesn't matter. And it assumes the pension fund beneficiaries, the teachers and nurses and factory workers whose retirement savings flow through those institutional investors, somehow chose this risk knowingly. They did not. The trillion-dollar private credit machine was built in the space between what was legal and what was visible. And the history of financial crises suggests that is precisely the space where the next one always hides. If you want to understand the full picture of how leverage and opacity interact in today's markets, you need to see how deep this goes. Airlines don't make money flying you anywhere. They make money on the miles you'll never use. That story is up next on your screen. And once you see it, you'll never look at a boarding pass the same way again.